So now we're going to talk about the application of taxes and how it affects an otherwise free market, one with voluntary exchange. So probably the issue that affects students the most in trying to understand this issue and the economic analysis is they have to differentiate between the concepts of tax levy and tax burden. So we'll talk about this as we go through this segment of the lecture. But the big issue is that when the government levies a tax, they levy it on a particular party in a transaction. So we're talking either the buyer or the seller, typically. And if they levy it on the buyer, then that means the buyer is responsible for collecting the tax from the transaction and writing the check to the government. That's an administrative requirement, and a lot of people think that means that the buyer is paying the tax. Likewise, they can levy the tax on the seller, and again, that's an administrative requirement to interact with the government, fill out forms, and write a check for the amount of the tax that was collected in the transaction. But when we think about who's actually paying for the tax, we want to use the idea of tax burden. And so I can give you a really quick summary of what happens with tax burden. And in the case of tax burden, think of a buyer that's really desperate for a good. And we'll talk about how we conceptualize in a model what we mean by desperation in a moment. But they really want the good. It's somebody that has diabetes and they're buying insulin. Well, you can realize if there's a tax on that good, even if the tax is levied on the seller, which means the seller has to collect the tax and write it to the government, the seller can mark up the price by the amount of the tax, and the buyer, because they're desperate, will still pay the full amount. So even though the tax is levied on the seller in that example, it doesn't really affect the economic circumstances of the seller any, because they're able to pass on the tax completely to the buyer. Well, that gets to the issue of tax burden. In our analysis, we would say that even if the tax is levied on the seller, if the buyer's desperate, then the economic burden of the tax is going to fall on the buyer. And likewise, you can imagine a seller that's desperate to, get rid of something, and there's a tax on that good. Even if the tax is levied on the buyer can negotiate for a really low price, and it won't really affect the buyer any. There will be no burden on the buyer. So we spend a lot of time in this lecture differentiating between these concepts of tax levy and tax burden, because to lay people that haven't studied economics, those issues often get confused and conflated. So let's go ahead and go on. But like I said, this introductory comment is to make sure that you guys are looking for the difference between tax levy and tax burden. So, how taxes on buyers and sellers affect market outcomes. Basically, the issue is that whenever there's a tax, it generally discourages market activity because it charges an additional fee on the transaction. So people don't want to go forward with the transaction as much. I don't know if anybody here that's listening to the lecture has bought a car, but when you pay sales tax on a car, it can oftentimes, if you're buying a car that's $20,000 and it's 10%, then that's an extra $2,500 on the transaction. So you might be willing to pay $20,000 for the car, but having to pay $22,500 just because of taxes, well, that can slow down your purchasing decision. And that's generally what happens when we have taxes. So when a good is taxed, the quantity sold is smaller, and buyers and sellers have to share that burden. And again, we'll define burden precisely in a moment. So we want to talk about this concept of elasticity, and this is really how we discuss the concept of desperation on part of the buyer and the seller. So when demand for a good is inelastic, that is an indication that the buyer is desperate. Elasticity is this idea that buyers and sellers might be flexible in their decisions, but if you say they're inelastic, it means they're inflexible, which means they want to really purchase about the same quantity regardless of the price if they're buyers. And if they're sellers, they really want to sell about the same quantity. So if we say demand is elastic, it means that the buyers are very responsive and very flexible. They'll just buy something else. And if we say that supply is elastic, we're saying that the sellers are very flexible. They'll just produce a different good or do something else. They're not desperate to sell. They might put the good in inventory and wait for a better market opportunity. They have a lot of flexibility. And if they're inelastic, it means they're inflexible and they really need to go forward with the transaction. So look out for those words. So tax incidence is related to tax burden. It's the manner in which the burden of the tax is shared among the participants in the market, so shared between the buyer and the seller. So tax incidence is the study of who bears the burden of the tax, who's financially or economically impacted by the tax. And again, it's related to this concept of elasticity that we'll talk about in more detail shortly. So taxes result in a change in the market equilibrium. Buyers are going to have to pay more and sellers are going to receive less than they would without the tax. So without the tax, you can think of it, every dollar that the buyer is paying for the good is going directly into the pocket of the seller. But if there's a tax, some of the amount that the buyer is paying that actually leaves the buyer's pocket doesn't make it to the seller's pocket. Some of that goes away in the form of tax. So buyers are going to pay more and sellers are going to receive less, and this is regardless of whom the tax is levied on. Because remember, the tax levy is really an administrative requirement, a matter of law. So let's go ahead and look at our simple demand and supply diagram and the equilibrium we're familiar with. 100 units are transacted at $3 per unit. That's the equilibrium price and the equilibrium quantity with no tax. And now let's introduce a tax. And the way that we're going to introduce the tax into our diagram initially is we're going to show the demand curve shifting downward by the amount of the tax. That's equivalent to a leftward shift or a reduction in demand caused by the tax. And then we're going to end up with this second demand curve, which we're going to call the effective demand curve. Because it's effective in the sense that, remember, the demand curve measures the willingness to pay of the buyer. That doesn't change. The good's still worth the same amount to the buyer, but because some amount is being taken off and given to the government, what the seller's actually going to see, the seller's going to respond to this effective demand curve, the lower demand curve, which is lowered by the amount of the tax. So in this example, we're going to say that there's a tax, and we're going to say the tax is levied on the buyer, and it's a tax of 50 cents per unit. In this case, we're talking about ice cream cones, but 50 cents per unit. So we're going to shift down the demand curve by that amount, the 50 cents, because the buyer is willing to pay whatever they're willing to pay, but 50 cents of what they pay is going to go to the government, and then the sellers are going to see what's left over, which is that red effective demand curve. So if you look at where that shifted demand curve intersects with the supply curve, that's going to be where we see the equilibrium with the tax, and that's going to be the amount that the sellers are going to receive, and it's going to determine the new quantity in the market. So this is where things get a little bit tricky, because there's going to be a price the buyers pay, which is going to be off their original demand curve, because we're going to add to the amount that the seller receives the amount of the tax, because the buyer's paying the price plus the tax. And then the sellers are going to receive that amount where the new shifted demand curve and the supply curve cross. That's going to be the seller's amount that actually goes in his pocket, after the tax is taken away. So in this example, the buyers are going, as a result of the tax, pay $3.30, and then 50 cents is going to the government, and then the sellers are actually going to receive only $2.80. So that's the seller's after-tax price, and we have the price the buyer pays before the tax of $3.30. Now, I want you to notice that if you compare it to the before tax equilibrium, then you can notice that the buyers are paying more than they were paying before, but only a fraction of the tax. The tax is 50 cents, but the buyers are only paying an additional 30 cents because of the tax. And the sellers, they're receiving not $3, but only $2.80. So they're not suffering the full amount of the tax, but only 20 cents of that 50 cents. So you can see right here, if you look at the after-tax price for the seller and the after-tax price for the buyer, that 50 cents is being divided between them and affecting both of their economic circumstances. So even though the tax is being levied on the buyer in this example, because we're shifting the demand curve down by the full amount of the tax, it's not true that the buyer is suffering all of the economic consequences or the full burden of the tax. So you can see the difference between those after-tax prices of the full amount of the tax. And now we want to talk about the impact of the tax and how it relates to this idea of elasticity. So taxes discourage market activity, and when a good is taxed, the quantity of the good is smaller, and buyers and sellers share that burden of the tax. But if we go ahead and now we're going to consider the case where we have a tax on sellers, and by that we mean that the sellers have the tax levy, so they have that administrative requirement, and we're going to see the supply curve now shifting up by the full amount of the tax, and that's going to determine the location of our new equilibrium. So here in this example, we still have a tax of 50 cents, and we have an after-tax equilibrium, but now notice that the effective supply curve, the red supply curve, is crossing the original demand curve at the point of our new equilibrium. And that's going to be the buyer's after-tax price, and 50 cents below it is going to be the seller's after-tax price. And so we're still seeing the difference of 50 cents and seeing that shared between the buyers and the sellers. So the main takeaway is that who has the administrative requirement doesn't affect the equilibrium. It just affects how you do the analysis. Either you're going to shift the supply curve up, or you're going to shift the demand curve down by the amount of the tax to find the new equilibrium. And either you're going to be finding initially the buyer's after-tax price or the seller's after-tax price, and you're going to have to add to that the amount of the tax to find the price of the other party. So let's do a really quick example, and this is an example of the payroll tax. So the payroll tax is a tax you're going to see if you look at your paycheck. You're going to see that there's an amount that's taxed, and it's paid directly by suppliers. And now we're not going to show, because it doesn't matter, we're not going to show the shifted supply curve or the shifted demand curve. We're merely going to show where the tax would show up in our diagram and how it drives what we call a tax wedge, or it drives a distance between the price that buyers pay and sellers receive. In this case, in labor demand, it's businesses that are purchasing labor, and it's workers that are supplying labor. So we see that the wage that the firm pays less the tax is the wage that workers receive. And we didn't have to introduce whether it was a buyer levy or a seller levy. Even though it shows up on your paycheck, it's not really affecting your net wage after taxes one way or the other. So in what proportions is the tax burden divided, and how do the effects of taxes on sellers compare to those levied on buyers? Well, the answers to these questions really depend upon that elasticity factor, or the desperation factor of the people that are buying or selling. So let's look at a demand and supply diagram, and we'll introduce a tax wedge. And then notice here the demand curve is relatively steep, which means it's inelastic. As we change the price, the buyers are going to want to purchase approximately the same quantity. And you can see here that the majority of the tax burden, the amount of the tax actually causing an economic consequence is going to fall on the buyer. The buyer's price is going to be much higher than the original equilibrium price that's paid by the buyer. But the producer doesn't have much of a tax burden. And the price that the sellers receive isn't that much lower than the price that the buyer is paying. Than the original equilibrium price. So if we have an elastic demand, so now the demand curve is flatter and the supply is relatively inelastic, it's steep, which means the sellers want to sell about the same quantity regardless of the price, so they're more desperate. And then you can see that the incidence of the tax, or the tax burden, really dramatically affects the price that the sellers are receiving as compared to the before tax price. So here, the sellers, because their supply is inelastic, are bearing most of the economic burden of the tax. So, and consumers, their after-tax price isn't much higher than the before tax price that they were paying. So in summary, how is the burden of the tax divided? Well, the burden of the tax falls more heavily on the side of the market that is less elastic, so less flexible. And our summary basically is that taxes, we know they're used to raise revenue for public purposes. The government levies taxes on goods, and the equilibrium quantity of the good exchanged in the market is going to go down because of that. Tax on the good places a wedge between the price paid by buyers and the price received by sellers. So, what we mean by a wedge is that the buyers are actually going to pay some amount of money coming out of their pocket. You're going to take off the amount of the tax, and then that's the amount that's actually going to go in the seller's pocket. So the language here, don't let it trick you. I think a lot of times students get confused because they're used to paying sales tax, and that's just the price you pay, and they don't ever think about the amount that the seller is actually receiving. You see a price on a product at Target, you go to the cash register, and you see that tax is added. Well, in our way of thinking about it as economists, what you actually pay is the price including the tax, because that's your full economic consequence. You can't go to the cash register and say, well, it said that the sunglasses were $20. I didn't expect to pay the $2 in tax. No, you're actually paying the price including the tax. So you're paying $22 out of pocket. $2 is going to the government. And then that price you see when you look at the sunglasses that are on the rack, that $20 is what's actually going in the pocket of the seller. So in terms of incidence of the tax, or the tax burden, we know that the tax incidence isn't affected by these administrative issues of levy, whether the seller has to write out, the check to the government or and collect the tax, or the buyer has to do it. Instead, the incidence of the tax depends upon this issue of elasticity of supply and demand, whether or not the buyer in a particular case is flexible, and if the tax is too much, they just don't want to pay it, so they'll go do something else, or the supplier is more flexible. So whoever is less flexible, whoever it has a less elastic response to changes in price, whoever has a steeper demand or a steeper supply curve, they're going to be the ones that end up suffering the economic consequence or the burden of the tax more. Okay, well, thanks, and I'll be talking to you soon.